Hello, everyone. In this video, I'm going to talk about the share dividends and share splits. And we are covering the third learning objective of this chapter. This chapter is chapter 14. So another type of dividends, along with the cash dividends, another type of dividend is paid out in shares. This type of dividend is called a bonus issue. Okay, so a bonus issue is not a true dividend because it's not paid in cash. The effect of a bonus issue is to increase the number of shares that each owner holds. Since there are more shares outstanding, each is simply worth less. Okay. A bonus issue is commonly expressed as a ratio. For example, a 1-for-5 bonus issue means that a shareholder receives 1 new share for every 5 currently owned shares. Okay, so which means that there will be a 20% increase in shareholding. Since every shareholder owns 20% more shares, the total number of shares outstanding rises by 20%, and the worth of the share will decline by 20%. Okay. So the main idea is, as a shareholder, you get shares. So you have more shares now. As a result, each share will worth less. So the value of your shareholding will essentially remain unchanged. Okay. Now let's talk about share split. A share split is essentially the same thing as a bonus issue. Okay, when a split is declared, each share is split up to create additional shares. For example, in a 3-for-1 share split, each old share is split into 3 new shares. Okay, although share split is observed in many countries, it's rare in Australia. A related but different item is an automatic dividend reinvestment plan, which is called DRP, Dividend Reinvestment Plan in Australia, and DRIP in the US. It's a plan in which shareholders have the revocable option to partly or fully reinvest their paid cash dividends. So cash dividends and DRP are taxed in the same manner by the tax authority. Okay, shareholders can still opt in or out of the DRP subsequent to the firm's latest cash dividend announcement, an investor decision which is beyond the control of the firm and its dividend policy. Okay, so which means that, for example, a company declares a cash dividend and you may opt that this cash dividend is reinvested in company shares. So instead of getting that cash, you essentially will have more shares now. Okay, so coming back to the share split, as I already gave you an example, if you want to see another example, you see that, for example, when there is a 4:1 split, it means that each share that you currently hold will be split into 4 shares. As a result, each share will be worth less. For example, if a share currently worth $10 and it's split into 4, then each share will worth $2.5. Okay, so number of share increases and the share value decreases. Okay. Okay, now let's talk a little about the value of share splits and bonus issues. The laws of logic tell us that share split and bonus issues can leave the value of the firm unaffected and increase its value or decrease its value. Okay, so it's either is possible that the value remains unaffected, increase its value, or decrease its value. Okay, unfortunately, the issues are complex enough that one cannot easily determine which of the 3 relationship holds. Okay, so first of all, if you consider a benchmark case, which is a strong case can be made that bonus issue and share split do not change either the wealth of any shareholder or the wealth of the firm as a whole, as I was discussing earlier. The reason is that they are just paper transaction and simply alter the number of shares outstanding. For example, if a firm declares a 2-for-1 split, all that happens is that number of shares is doubled, with the result that each share is worth half as much and the total value is unaffected. Okay. So although this is simple conclusion, but it's relatively obvious, there are reasons that are often given to suggest that there may be some benefits to these actions. Okay, the typical financial manager is aware of many real-world complexity, and for that reason, the share split and bonus issue decision is not treated very lightly in practice. Okay. Now, look, that those who support bonus issues and share split frequently argue that a security has a proper trading range. This is normally in countries where the stock exchange imposes a minimum number of shares that must be bought, which is no longer the case in Australia and New Zealand. Okay. So where there is a minimum trading unit to buy or sell shares, when it's priced above the trading range, many investors do not have the funds to buy the common trading unit of 100 shares, called a round lot. Okay, although securities can be purchased in odd lots, the commissions are greater. Okay, so thus the firms will split the shares to keep the price in this trading range. Okay, although this argument is a popular one, its validity is questionable for a number of reasons. So many stock exchanges have removed the restriction on the number of shares that must be bought at a time, instead setting a minimum value for transaction. Superannuation funds, managed funds, and other institutions have steadily increased their trading activity. Okay, so because these institutions buy and sell in huge range, the individual share price is of little concern. Okay, furthermore, we sometimes observe share prices that are quite large without appearing to cause any problem. Finally, there is evidence that share splits may decrease the liquidity of the company's share. Following a 2-for-1 split, the number of shares traded should be more than double if the liquidity is increased by the split. It does not appear to happen. The opposite is sometimes observed. Okay, so while a split is possible, sometimes reverse split also happens. Although it is less frequent, but there is a financial maneuver called reverse split. Reverse split generally range from 1-for-2 to 1-for-10. So in a 1-for-3 reverse split, for example, each investor exchange 3 old shares for 1 new share. Theoretically, the value is tripled in the process, provided no other information is given in the reverse split announcement. As with share splits and bonus issues, a case can be made that a reverse split has no real effect. Given real-world imperfections, 3 related reasons are cited for reverse splits. The first one is transaction costs to shareholder may be less after the reverse split happens. Second, the liquidity and marketability of a company's shares might be improved when its price is raised to the popular trading range that I was talking about earlier. And third, shares selling at prices below a certain level are not considered respectable, meaning that investors underestimate these firms' earnings, cash flow, growth, and stability. And some financial analysts argue that a reverse split can achieve instant respectability. Okay, as was the case with share split, none of these reasons is particularly compelling. Okay, especially the third one. Okay, so that's the end of our discussion about the bonus share split, and reverse split. Thank you very much.